Welcome back to Bullish. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Thank you for listening. Episode number 4 here. A great week, some great companies that we're going to be covering. Really, these next 2 weeks, very retail heavy. This week, we're going to be looking at KKR, Tyson, Home Depot, Cardinal Health, Amcor, Cisco, Target, Walmart, Applied Materials, John Deere, Palo Alto Networks, Estee Lauder, Zoom, Lowe's, Macy's, Medtronic. Remember, not an individual stock advice. Past performance, not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nick, any commentary before we get in here?
Okay, Sam, good morning. How are you doing today? It is a packed week. I know you mentioned this. Lots of retail, very exciting. A mixed bag of results. Stocks are responding in various ways. But I personally can't believe school is starting back up. Here we are. It's already August 25th. Very exciting. And it's crazy. I can't believe it. We're on 125 episodes of my show now. We're already, what is this, episode 4 of Bullish. So this is, it's pretty fun. I can't believe how fast the year has gone.
Yeah, very excited for fall. Happy that we're out of the heat. I know our Houston folks are going to think that we're weak as all get out. They really had a hot summer. This past week's been brutal. It's about as hot as it gets here. Very glad, I think, that we're through it. Excited for a cooler weekend.
Yeah, it was toasty. We were downtown yesterday presenting to a wonderful group of CPAs. That was our 3rd year doing that now. But I will say I almost had to change suits on the way from the car to the venue. It was toasty. It was hot.
Yeah, I could tell when I saw that picture of Bond walking down the street holding the box of materials. Poor guy. I'm glad that you made him do it instead of you. Anyways.
Well, Bond, yes, he was carrying the materials for the presentation. I snapped a picture of him because he did look like he had just been laid off. And he, of course, was not laid off. He's still employed by the Stenger Family Office. But
still an owner. We still love him.
We love Bond, but great picture. Maybe we'll share it next week. Yeah,
we could pop it up. Okay, let's get into it here. KKR is the first one, beat estimates with revenue of about $1.25 billion. Currently looking at AUM, $519 billion. They had $420 billion of fee-paying assets under management, about an increase of 9% here. We're looking at earnings for them, about $600 million, a 31% increase year over year. Stocks down about 1% as of last night when I ran all these numbers.
KKR, very interesting play on private equity. For those of you who don't know, they have a portfolio of companies. They're one of the big players, like Carlyle Group would be, like Blackstone, like a lot of these companies that are publicly traded, which is sort of interesting. They're publicly traded, but they're really private equity plays. And I like them from the standpoint that it does give you a little bit of access in a liquid way to private equity, but it's going to be very dependent on, obviously, the underlying value of their portfolio, the markdowns, the markups. Hopefully, you get more ups than downs. But over time, these private equity publicly traded stocks have actually been decent enough investments. And if you look at KKR, I wouldn't get too wrapped up in the day-to-day of it or the quarter-to-quarter, but the past 5 years now, it's up 125%, currently paying a small dividend. And this is kind of a nice way to get access to some private equity without having to get locked up into a deal. I think there's a lot of companies that have waited to go public that otherwise would have, that are owned by a company like KKR because of higher interest rates. And so it's been a nice way for people to have access to companies they wouldn't have access to. Look at Policy Genius as one of their holdings. Slice, which is the company, I think, does all the pizza reviews. We mentioned there are a couple at the top here, 1-800-CONTACTS that most people would know. So they've got a nice portfolio. It's obviously very diversified. And KKR is trading at a $50 billion market cap. So it's a nice little spot to get into, not little at all. $50 billion is a substantial market cap, but it's going to give you access, I think, to some of the activity in the private side. Not direct access. You're never going to get the returns of an actual private equity fund, and you sometimes don't actually want that because a lot of private equity doesn't really perform, especially when you take into the fees into account. So if you're going to do this, I think a nice way is to have a small allocation to a company like KKR. Again, none of this is stock advice, but it's just something that we look at in the portfolio.
Well, and to your point too, much more liquid. You're not having your dollars locked up by them or anything like that for certain periods of time. So, no, that was great. Let's do Tyson Foods. Missed all over the place. Revenue was sitting about $13 billion, down 2.3% year over year. Net income down 156%. Definitely some restructuring to some extent happening over there. They closed 4 chicken processing facilities, basically trying to lower costs, maximize capacity of the facilities that they have moving forward. I know they actually closed down all their Chicago operations recently. Everybody from up here who was willing to make the moves going down to Arkansas, but kind of a way to downsize number of employees as well, is what it seemed like to me. And then, just a comment, seemed like prepared foods kind of where their driver of growth is as far as margins are going moving forward here. But, stock's down 4% since the release and kind of been battered here for a long time.
Yeah, we added Tyson a little earlier this year, and I will say the trade was a little early from a timing standpoint. We got in kind of at the high 50s. Right now the stock's trading at 54. But I still really like the story long term, and food is going to be such an important part of our economy going forward. A lot of people don't realize how important. We're going to talk about John Deere in a second as well, so I'll say some agricultural comments for that as well. But I think agriculture in general, the food industry is vital to obviously our survival. Tyson Foods is in this place of lower cost. It's obviously frozen chicken, things like that. And I think that will do well over time, especially as we continue this high inflationary environment where people are looking for a value. And if you look at the stock on a forward price to earnings basis, it's trading for 13 times forward earnings, slightly higher than the 11, which is where it was the past 5 years roughly. But if you look at the stock, it's still in this is my opinion, but it's still in this unique buying opportunity zone where it goes through these cycles of boom and bust, where you had a big peak up in 2016, you had a big peak up in 2018, a big peak up in 2019, a big peak in 2022, last summer, and now it's in one of these correction zones. I don't see why you would want to panic and sell it now if you've held it through the cycle. We just got into it very recently, so I like it. We're getting a 3.5% dividend. Could be a while till we see some return there, but I still think if you look at this thing over the next 2 to 3 years and give yourself some time to hold it, you're going to see some decent returns.
Yeah, and if you look at that max time frame, I mean, the last time it was trading at this level was 2015, I believe, late 2015. So to your point there, just confirming where we're kind of at as far as the cycle goes. Let's jump to Home Depot. Beat top line estimates with $43 billion in sales, roughly 2% decrease year over year, which is actually in line with the guidance that they had. Earnings per share down almost 8%, which was also in line with guidance. Net income down about 10%. Profit margin was down 8%. Stock, as we're looking at it, was down 2.2. To some extent, they were expecting this because they knew retail or DIYers would drop down to some extent. And we'll talk about Lowe's a little bit later, but similar story there.
Lowe's and Home Depot, and maybe we can lump Lowe's in here too. I don't know if you want to just mention that as well, Sam. Yeah. I'll make a comment on Home Depot, and then we can touch on Lowe's as well. But I just think this is one of those stocks, and we've mentioned a couple of these names on the show before. Procter & Gamble was one of them, either last week or the week before. There's a handful of names where you would be, I think, really mistaken to sell them, to panic out of them, because they're such great companies long term. They really should be the bedrock of a portfolio. And it's not to say you put 10% in Home Depot, so don't hear me wrong. But what I am saying is a couple of these stocks, like Home Depot, are such great American companies that they're going to provide a nice core portion of your portfolio. This thing has beaten the S&P the past 5 years. It pays a 2.5% dividend. They did $13 billion in the third quarter. absolutely incredible, even after a small pullback from last summer. But you have to remember, I think a lot of these home renovation stocks, we talked about Sherwin-Williams a couple weeks ago in this same regard, that because people can't move, because they can't leave their house and leave that 2.5% mortgage behind and go to 7, or at least they don't want to, a lot of the home renovation stuff, I think, is going to start to pick up. We had one of our really close friends who said, yeah, we were thinking about moving. We'd like a little bit bigger of a house, but it's cost prohibitive with interest rates. We're just going to do an addition, for example. We're going to remodel our backyard. We're going to do a landscaping project. We're going to do a bathroom remodel. So a lot of people are going to do projects because they can't move. And that's where I think a Home Depot comes into play nicely. It's a data play similar to Walmart, where they know exactly what they need to order. They know what consumers are doing. They have a really nice pulse of the consumer going, so they know what to expect. And I think that's something where you would want to stay in it for the long run. And by the way, I think I said the wrong number on revenues for the third quarter. It was actually $43 billion. So just a tremendous number. That's an insane amount of sales. And then why don't we talk about Lowe's? You can mention some of that, Sam.
Yeah, and to just piggyback off that as well, I know I was listening to some other guys who have a great show where they were talking about home sales, existing home sales, as far as the number of homes sold, down 20% right now. So really we could see, to your point, lots of people opting for other choices, which would really help boost some of these Home Depot, Lowe's, continue to be long-term great opportunities. Yeah, Lowe's, very similar. So they barely missed. I think they missed by maybe $400,000. They were at $25 billion this year, down 9% year over year. If you look at comparable sales, it was down 1.6%. As I had mentioned, biggest headwinds they talked about was lumber deflation, as well as DIY discretionary spending being down. Net income down a similar amount, about 10%. Earnings per share was down about 2%. Stock actually is up for them 2% since the release, and they're having a decent year.
Lowe's is, I like owning Lowe's and Home Depot side by side. Lowe's is a lot smaller than Home Depot, significantly smaller. They did,
half the size, roughly.
About half the size.
60% of the sales, if you look at it.
Okay. Yeah, so it's more of a growth play if you want to look at it that way. I would imagine at some point it would be as big as a Home Depot, but I really like owning them side by side in the portfolio, where you don't have to go all into one or all into the other. And if you want to have a 2% total weight, for example, you could be 1% Lowe's, you could be 1% Home Depot, and have a nice balance there. If you wanted to overweight Home Depot, we tend to do that a little bit more. We do a little bit more in Home Depot, a little bit less in Lowe's. But that entire play on the home renovation, on home improvement, I think that's going to be a nice theme for a while. And Lowe's is going to be more of your beta, your non-beta play, right? So Home Depot is going to give you a little bit more stability, I think, going through the entire cycle. Lowe's might have more downside because it is trading at a slightly higher price to earnings ratio with a lower dividend. But at the same time, it's going to be more of the when times are really good, I think it's going to outperform just a little bit. And it shows up in the 5-year number. It's up 105% price return versus, like I said before, Home Depot is only up about 60% the past 5 years, which is still a really good return.
Yeah, Home Depot is kicking off like 60 bips more as far as dividend goes. That was great. Anything else that you want to say there?
No, we can move on.
Cool. Let's do Cardinal Health. Revenue was $53.5 billion, beat their estimates, 13.5% increase from last year. They saw, which this is their biggest segments, pharmaceutical revenue up about 15%, and then medical revenue was flat year over year. I think pharmaceutical, if I remember correctly, is like 49 of the 53 billion. Pharmaceutical, I have a note here. Pharmaceutical segment is 93% of the revenue. Anyways, all that being said, earnings per share, net profit margin were down about 150, 140% respectively. Stock's down about 7.3% right now as we're looking at it.
Cardinal Health is a diversified healthcare play, which is pretty good. I think one of the problems you run into with healthcare investing is if you're buying a pharma stock, for example, it's very dependent on the drugs they come out with, right? If you're buying a healthcare clinic company, like there is Oak Street Health that was bought, but they're going to be very tied to what's going on with Medicare and insurance and regulation. So one of the nice things about Cardinal, and we don't actually have it in the portfolio, we may look at it down the road. I think it's probably a little bit rich from a valuation standpoint today. That doesn't mean it might not change for us down the road. The one concern I do have is that the forward price earnings ratio on it is 14 versus the 5-year average being 10. So that's one area where we may add it down the road, just not now. That's just our personal opinion. But it is diversified, which means you're going to have a lot more stability, I think, of earnings long term, where they've got hospital and healthcare, they've got community health, they've got manufacturing, they've got a long-term care business, they've got a pharmacy business. So they've got a lot of different areas that they can operate in, as opposed to being so tied to medical devices, for example, or so tied to pharma, which is, I think, a decent way to play the healthcare space in general.
Great. Amcor next, missed on the top line, revenue about $3.6 billion. Revenue decreased 6% year over year. Sales by segment, if we're looking at it, flexible packaging for them was down about 6%, rigid packaging down 5%. If you look into some of the other things, pretty strong. Earnings per share up 71%. Net profit margin was up 75%. The stock is basically flat. I think it was down 84 bips and up today. So, pretty much flat since earnings came out.
This is not one that we have in the portfolio, but Amcor to me is not the best company on earth. It pays a big dividend for a reason, and that's what we always warn investors of, is when you see those 5, 6, 7% dividends. I think they're sitting at 5 right now. But when you see those dividends, you just have to ask the question, why are they paying a dividend like that in general? If they're paying it because it's a growth story, right? They keep growing their dividend. That's fine. That's great. And then you see some top line revenue growth and profit growth as well. Those things can sometimes go hand in hand. But if it's just paying a dividend because the stock is down over the past 5 years like it is, that's where we would issue some caution. You could have bought this thing in 2019 for $11. Well, guess what? Today, it's trading for $9.40. So that's a little concerning to me. That's where I would just be, thinking kind of longer term about the quality of the earnings as opposed to the rate of the dividend.
Okay. That's fair enough. Cisco beat across the board, had 15.2 billion in revenue, increase of 16%, earnings per share up 42%. Highlights for them, annualized recurring revenue was up 5% year over year. Their software and software subscription revenue was up 17 and 20% respectively. And remaining performance obligations were up 11%, almost $35 billion there. So stock's up about 3.5–4% since the release.
I've actually been very surprised by Cisco's performance, especially year to date, past 12 months. 5 years hasn't been anything to write home about. And then, of course, everybody knows the story with the dot-com era with Cisco, and I think this is where a lot of investors they've been a little bit gun-shy for good reason, and the stock, peaked way up in the 2000s, over $80 a share, which it never should have been trading at, and it still has not returned to those dot-com era levels, even 23, 24 years later now. And that's where I think people have always been a little bit concerned about the quality of the earnings there. Now, Cisco's transformed itself today into a much more diversified company. We obviously use a lot of their services, a lot of their products, and in some areas, they're very, very competitive. They were the original WebEx, which is not really used as widely anymore. They've pivoted more towards a cloud services business, which has been good. They obviously have very high gross margins. We've got a small weight that we just recently added to the portfolio, and I think that's going to pan out pretty well for us. It pays a 2.8% dividend, which is nice. But this, my opinion, really is not going to be much more than a 1 or 2% position in your portfolio. And there are some concerns. They have Cisco Meraki, which is the cybersecurity and all that. I think some of that's pivoting away from Meraki. I don't know if I'm saying that right. I'm not a tech person, but I think some of that could be pivoting towards a different model of cyber, and that could be a concern. So we'll see what happens. Again, I'm not overdoing it, but I like for a dividend, 2.8% dividend, you can't beat it.
Yeah. Next, two very big players in the retail space, Target, Walmart. Let's look at Target first. missed revenue at $24.8 billion, decrease of almost 5% year over year. Rest of their financials, honestly, were fairly impressive. Most notably, earnings per share was up 361%. Stocks down about 76 bips since the release. Continues a rough year, though. Year to date, they're down about 18%.
So the contrarians would say to sell Walmart and to buy Target. We don't own either of them in the portfolio. I'm just not the biggest fan of these retailers that are so dependent on quarterly earnings. I mean, these obviously every company is subject to the swings of quarterly earnings. These things in particular get whipsawed so much, and Target is, I don't know. My wife goes in there, and it's a lot of it's overpriced. She goes in once in a while, and to me, the value is just not there. We would go to Walmart and we could walk out with just a significant amount more stuff from Walmart than we can from Target and pay a fraction of the price. I don't know if you've seen that when you guys go to Target versus Walmart, the difference in your final bill when you check out. It's pretty substantial.
Absolutely. I agree with you there. Target's so dangerous, especially now with the boys and kids' clothes. Well, I just got them a couple of shirts. I'm like, it's the same price as if you went to some spot that's actually at the mall, but they just make it seem like it's less. So, I mean, the Target pickup, Walmart pickup, that stuff's very nice, but it's also dangerous. It's created a very easy kind of way to shop there, which maybe creates value for them moving forward here. But I know Target had a lot of other factors kind of going into why the stock is down as much as it is. Walmart, though, 9 times the market cap of Target. I mean, Walmarts are everywhere. It doesn't matter where you're at. You can find a Walmart to go to. And so I think that to some extent maybe helps with their pricing as well. They just do so much more volume.
Well, Walmart also pivoted to online a lot faster than Target did. Target did it, and I don't think they did a bad job of pivoting online, but Walmart did a much better job directly competing with Amazon, and that's the 800-pound gorilla is Amazon. Can you reasonably over time believe that you're going to be able to grow your revenues and your profits as much as a company like Amazon that has this AWS business powering it? And that's the main competition, and if you look at Target and Walmart in a vacuum and don't actually put Amazon up against them, I think that's the issue. I look at my online orders from Amazon, we're doing a couple orders a month. Here and there, we'll get certain things on automatic from Amazon, like our toothpaste or deodorant or mouthwash or whatever it is. That stuff is all Amazon, at least for our family, just because it's so seamless. You've got your credit card stored. You know what to expect. And Walmart was just late to the game. They didn't have that first mover advantage. Target certainly doesn't have that first mover advantage there. They could come out with a Prime equivalent if they wanted to. I don't know if a whole lot of people would subscribe. I just don't think so. I think it's almost like one of those things where if you missed it in the beginning, now you're already so far behind. And Amazon was able to do that early on because they knew the growth engine of their profitability would not be the online business, but rather the AWS, the cloud business. So they're able to do things that Walmart and Target just can't do. If Target tried to directly compete with Amazon, they would run into massive trouble with profitability long term. So what they're relying on is people coming into the store. They really need people to come in and to really grow long term. Like you said, the market cap on Walmart is so much bigger than Target now. Walmart is what, 422 billion, and Target is 56 billion. Yeah. So for Target to grow to the size of a Walmart or grow to the size of Amazon, which I think is highly unlikely at this stage, they would have to open up a ton of new stores. And we talked about this the past couple of weeks. New stores are very capital intensive, and that would destroy their profitability. So I don't know. People buy it for the dividend. I think that's kind of a mistake, and that's all it's going to be. They're going to have to return all their earnings to shareholders to get people to invest, and that's usually not a good long-term growth story.
Yeah, and I can just give Walmart's numbers really quick. So they beat their expectations, $161 billion in revenue. It's a 5.5% increase. Earnings per share was up, net profit margin up about 55, 44% respectively there. U.S. comparable sales up 6.4%. And to your point, Walmart being a little bit of a bigger player than Target is in the e-commerce space, not quite where Amazon's at. They did have e-commerce up 24%, largely due to increase in pickup and delivery orders. So you kind of forget that if you did order something online and then go pick it up, it still kind of fits into that e-commerce bucket. And their stock's only down about 1.5% since the earnings, but they're up 9% year to date as opposed to Target, who's down 18.
Yeah, and I think one of the things we should mention, because we're recording today, and Palo's talking right now. He just started talking about 3 minutes ago. And so the direction of where rates go, I think, is really going to affect this. If rates do stay higher for longer, let's say there are layoffs, let's say there are things coming, which I do think, just personally talking to clients, there's been a dozen people I've talked to recently that just got laid off. And this is a massive spike, at least just for our business. You're not seeing it in the data quite yet, but I do think layoffs are coming down the road. And if we do lay people off and we have people that are trying to pinch pennies and you're starting to see the consumer run out of that excess COVID cash, they are going to pivot, in my opinion, to the value option. They're going to pivot towards a Walmart. Now, the question is, how much has Walmart stock already absorbed in their stock price? They are trading for a 30 current PE ratio. Stock's up 64% the past 5 years without the dividend. Some of that's priced in. So that's where I've been cautious on both of these companies, is saying, if you didn't get into it 5 years ago, now to get into it, you've got one problem with Target, which is the fact that they're already the premium option. They're the place you go when you have a little extra cash. If you think consumers are going to not have the extra cash and go to Walmart, like a lot of the market thinks, well, now you're going to go buy Walmart stock already at elevated levels. So that's why I've issued caution on owning both of these things at this point.
Okay. Yeah, and maybe let's hit Powell at the end here and just give some first thoughts, since it is a very important thing long term and short term for what's going to happen in the economy potentially here. So let's hit that in the end, and we can I know you'll probably talk about it more in depth on your show next week as we kind of see some of the effects of it hit, but we can give some first thoughts there. We'll jump to Applied Materials here, semiconductor company. They missed top and bottom line expectations. Revenue just shy of $6.5 billion. It was down 1% year over year. Operating margin was up slightly, if I remember correctly, 28%. Earnings per share down about 2%. Now, their leaders continued to be Internet of Things and also this AI era in which they are big players in. So stock's up about 3% since the release, and like most things that are heavily invested in AI, it's up 50% year to date.
Applied Materials has done so well. It's been such a just completely ripped the past 5 years, up 229%, and it actually does pay a small dividend. It pays a higher dividend rate than Apple, believe it or not. So the stock's done very well. This year it's up 47%, if you can believe it. And anything that's going to be in this space of powering the AI revolution, whether you think it's complete nonsense or you think it's actually going to be substantial long term, I tend to think it's a little overblown, the AI push. I don't think you're going to be able to replace humans completely. And actually, I think what will happen is AI is going to lead to more jobs than people realize. Yeah. Next show, it'll just be two robots talking to each other instead of us, and they'll probably do a better job. But I think
ChatGPT.
Yes, ChatGPT. But when you're in these companies like Applied Materials, and there's a bunch of them like this, and NVIDIA too. Are we talking about NVIDIA today? I couldn't remember, Sam.
No, NVIDIA, I know they came out yesterday, but we had a little catching up to do. NVIDIA will be next week.
Okay, so when we talk about NVIDIA, I'll say this again, but Applied Materials, NVIDIA, all these stocks are sort of the pipes and wires methodology of investing in the next thing. And what I mean by that is you go back to the gold rush of the 1800s, when people were just everybody's rushing out to California or wherever else, and the people that made a lot of money, maybe even more than the people in the mining for the gold, were the people with hotels out there, people with restaurants, people selling them the pans, right? That's the pipes and wires. Same thing with the energy business, owning the pipes and wires, the pipelines that all the majors have to use, for example, is a better business, in my opinion, than actually having to do the drilling. So that's where Applied Materials fits in as far as their industry is concerned is they're providing a platform, they're providing materials and products that are going to power a lot of what other companies are going to have to do to transform their businesses. So I like it. You're paying a lot more for the earnings today than you maybe would have liked, but on a relative basis, I think you'd be making a mistake to not own this thing.
Okay, let's jump over to John Deere, who I know you'd mentioned earlier that we would be talking ag. Beat top line estimates, $14.3 billion in revenue. Overall, really strong. Revenue up 12%, sales up 10% across all channels. Production and precision, the smaller and turf, construction and forestry actually had the highest sales increase at 14%. We're looking at net income up almost 60%, earnings per share up a little over 60%. Stock's down about 7.5% since those earnings did come out. So give us your thoughts there.
Okay, so I'll just preface this again. I know we've said the disclosure a few times already on the show, but I'll just preface this by saying this is not stock advice. This is not you go out, buy this stock. I'm just telling you what I believe, what we've done with our portfolios. We really like the stock. This is one of our top ideas for the next, let's call it 5 years. And we used to own it. We took some profit on it not too long ago, back in October of 21. And it's gone up a little bit since we took some profit. I was waiting for a buying opportunity to get back in, post those 2022 peaks of $445 a share. Deere is a tech company. So don't think of this as an equipment company, as a manufacturing stock. It is all those things, but it's also a tech company. I think that's the first and foremost thing to realize. They are making machines that are going to be completely autonomous. And the difference between autonomous driving with a company like Tesla versus a company like Deere is that Tesla, if you're going to have a driverless car, it's got to go through a million different regulatory hurdles. It's going to be years until you really truly figure out if Tesla is going to have a sustainable autonomous model, which I think they will. I actually do think it's coming. I just don't think it's coming as fast as people think. The difference with the John Deere is it doesn't face those same hurdles. You can put a driverless tractor in your field and have it operate at 90-95% effectiveness and be 95 or 98% successful. And that's a very, very good number. The problem with farming is twofold. Number one, we are going to face a food shortage. People don't realize this. We are going to face a shortage of food at some point in the future. Ukraine's been taken off the map. That's the breadbasket of the world. Brazil is trying to come on and absorb a lot of that. So Brazil is going to be an interesting place to watch. And if you listen to John Deere's earnings, they are heavily investing in Brazil and Latin America because that's going to replace a lot of the Ukrainian fallout. But also, in America here, there are 2 million farms. Most of them are family owned. And Sam, you and I were talking about this the other day. They face the biggest headwinds, and it's the input costs, right? It's if you have a fire or a flood or something goes wrong that you can't control, there's insurance for this, there's hedges, all that. But John Deere is going to allow them, in my opinion, to operate a higher degree of profitability and completely transform the farming business into a tech business, which is so exciting. That's so cool. And so I like it. I really think it's going to be one of our top stories the next couple of years. It's trading at a much lower multiple than it used to be. I think the PE will jump up a little bit here, but it's not going to jump up into unsustainable levels. Be aware, you could go down to 350 in the short term. I think you could have some pullbacks there, but I think long run, this stock is a double the next 5 years. Not a guarantee. Past performance, not a guarantee of future results. So that's my disclaimer. But just as a portfolio manager myself, I do think this is going to double over the next 5 years.
Yeah, well, you touched on it a little bit too, as far as the financing. I mean, the technology in these things is so far advanced these days, and they carry a big price tag, which also means people have to finance these, which they're able to clip some extra off that as well. So another good point that you brought up there. Let's go to Palo Alto Networks here, cybersecurity. So barely missed their revenue estimates. They saw a 26% increase in revenue. some outrageous numbers for net income and earnings per share. They were up 6,800 and 6,300% respectively. So set up well for the future. You know, they had a 30% increase in remaining performance obligations, which is obviously a nice sign in this area. And then stock was up about 9.5%. Another, you know, fantastic year here, 64% year to date, last I saw.
Yeah, Palo Alto Networks has been one of our top performers, and I don't know if you know the top one, Sam. You'd probably be surprised to hear this, but our top performer the past 3 years in our Resilient America portfolio has been AutoZone, up 92% since we bought it. Palo Alto is right behind it at 82%, so it's ripped. It's been a top performer. You are paying a lot for their earnings right now. I'm not selling it, so I'll just make that clear. We're not selling Palo Alto Networks. But as far as buying more and adding to it at these levels, again, you just have to pay attention to price. It's not a bad company. It's a fantastic company. It operates in a great space. They're operating in the cybersecurity world, which is clearly a concern of all Fortune 500s. And they're not selling cybersecurity. They are, but that's not really what it is underneath the surface. What they're really selling is insurance. So, and I know I'm saying this as an analogy. It's not really an insurance company, but they are behind the scenes going to companies and say, we can operate as a buffer for you to make sure that you don't get yourselves into the front page of the Wall Street Journal. And a business like that, long term, I think is going to be very, very, very profitable. Again, it's rich. It's trading at a forward P of 100 times. Now, that's not to say it can't keep going up. That's why I'm not selling it. But just be aware, if you buy it here and you hold on to it for a while, you could see some volatility in the short run. But that's not to say it can't be like a NVIDIA. NVIDIA came out with $2 in earnings, and I know we're talking about this next week, so I won't talk about it too much right now, but their earnings completely ripped higher to the point where now their PE is actually reasonably valued, in my opinion. So that's where you could see something like this with Palo Alto Networks. Short run pullback, long run, I think, going to be a great stock to own.
Great. Let's do Estee Lauder next. They are the second largest cosmetics company in the world, which truthfully I didn't realize up front. Maybe if we had asked our wives, they'd have had a better idea than us on this one. Beat estimates fairly handily. Revenue was $3.6 billion. Year over year net sales for them up about 1%. Skincare was their only segment that was down. It was down about 5%. Now, that is their biggest segment. If you look at it by geography, Europe, Middle East, and Africa was the only one that was down. It was down about 15%. Not necessarily their biggest. Obviously, America's is the biggest there. But earnings per share down 160%. Stocks down almost 7% since the release. Overall, they've had a tough year.
Estee Lauder was in our portfolio, and I will say we had very good timing on this. I don't know if it was just pure luck or what, but we do have a rules-based approach where we did take profit on it, which I'm happy we did. We bought it in 2020. We sold it in 2021. We missed the top. We didn't get out at the complete top, but now we've actually started looking at adding it. We just added I think a 1% position, 1.5% position on this, and it's trading at a pretty deep discount. You mentioned that, you know, if you bought it at 300, you're paying the price right now. But I actually tend to think that this thing is reasonably valued for the go forward. And look at the price, $153 a share, which is literally $2 higher than where it was trading in March of 2020 after a major correction. And the stock is dirt cheap, in my opinion. Now, does that mean it can't go lower? No, of course it can go lower. But I think where it's at today is a very, very attractive buying opportunity. They've got some great brands, and I like it. I think it's a good stock.
Great. Let's talk Zoom. Beat estimates. Revenue was 3.5% higher year over year there. Net income up almost 300% as well. Largely driven by their Americas geographic segment. So stock's basically flat. It's up about 68 basis points. I put a note in here. Deepest condolences from us if you bought this at $560.
Yes. And isn't it Kathy Woods? Like, it's one of her top holdings, I'm pretty sure still. If you pull up ARC,
she still has it, yeah.
Yeah, she's a huge believer in this, and she talked about it on Josh Brown's show, The Compound and Friends. Which, by the way, it's a great show. If you're interested in a couple of other financial related shows, highly recommend it. Sam and I watch it every week. It's really good.
Yeah, that was the one I was mentioning earlier that brought up the housing stuff. It's a lot of those guys are great. Like Nick said, if you're looking for another show to listen to as well.
Yeah, they were talking about Zoom with Kathy. They actually had Kathy Woods on their show, and they were talking about Zoom, and they're like, why do you like this thing so much? It's a little strange. And she basically made the case to say this is the easiest, most obvious video networking or video webinar, whatever you want to call it, video meeting app that's the easiest to integrate for companies. WebEx is kind of out. We talked about that. WebEx was the pioneer. They're out now. Microsoft Teams is okay. We use Teams a lot. I actually don't mind Teams. Sometimes the way that the company sets it up for you is not good. Like if you're at a Fortune 500 and they use Teams and they package it or customize it, that can actually really mess with the latency and all that stuff. But Zoom tends to be this very easy, like plug and play with video. And then they also made the case, I'm not making this case, I actually don't really like the stock, we don't have it in the portfolio, but they made the case to say this is going to be the future of calling too. So they can go to all their customers and their Fortune 500 customer base and say, hey, not only can we do video calls for you, but we can also do phone calls, and we can replace your phone system, which would compete with Ring Central. So this is all stuff that Kathy Wood brought up on that podcast. Not a knock against her at all, so don't hear me wrong, but I just think some of these names are a little overblown. I hope she's right. I hope it works out, but not something that I'm willing to risk client capital on at this point.
Okay. Yeah, I agree with you there. Let's talk Macy's. Beat estimates year over year. Not the best story. Revenue down 9%. Net income, earnings per share, and net profit margin all down 108%. Stock's down almost 17% since the release. It's down 40% year to date here.
Macy's, the easiest way to figure out not to buy Macy's was I went into the store, I don't know, 2 years ago, 3 years ago, and it was in complete disarray. It was the worst store I've ever been in. Sorry if you work at Macy's, but it was terrible. You couldn't find anyone to help you. I didn't see a single employee for miles in there. They're massive. The clothes aren't put away. It's a complete mess. I don't know how this thing makes it long term. I'm going to make an early call here and just say this thing goes to zero. I don't wish that on them. I don't wish that on their employees. But from an investment standpoint, I think this thing's going to zero. You've seen it happen so much with these other companies, and I don't know. I don't know how these department stores make it long run.
Is anybody going to try and pick them up, do you think, or just let them fail?
No, somebody will buy them. I mean, somebody will pay something for this. They've got some intellectual property, but like, how many of these department stores have we seen come and go? It's just a really tough business. It's very, very tight margins, and all it takes is a small change or a small difference in consumer spending, and these things can literally go under. You saw Nordstrom today. Look at Nordstrom stock as a comparison, down 11%. Nordstrom stock is down 76% the past 5 years, yet it still trades at an 85 price to earnings ratio. So all of these companies, Nordstrom,
another one kicking off a massive dividend, and we'll talk about them next year or next week as well. I had them on our list, but look at that, over 5%.
Yeah, and you know what? Maybe I'm wrong. I'm willing to be wrong on these stocks. I just don't see the long-term growth story. I don't see how they're possibly going to get out of this conundrum, which is really sad. We've seen like Mark Schale came and went. Nordstrom could easily be the next Mark Schale. I hope not, because it's really a nice store. But I just think Macy's especially is going to struggle for the foreseeable future.
Okay. All right, last one here. Medtronic, so medical device company, beat top line estimates, revenue up 4.5% to a little north of $7.5 billion. All major segments up, so cardiovascular, neuroscience, surgical, diabetes. Now, net income, earnings per share down about 15%. Net profit margin, they saw a significant drop in. I will say, taking a look at the report, it's really a pretty cool and important company when you think about what they do. They did see a nice pop following the earnings, but down about 75 basis points since then, so basically flat. As you look at the stock as a whole, we're down near COVID level lows for them.
I really like Medtronic. I would say it's, we made a mistake buying it a little too soon. I call it a mistake, whatever. But I think long term the story is there. It's in a nice space economically speaking from a long term growth standpoint. We were talking about this at the CPA presentation that the top performing sectors the past 10 years or so has been technology, consumer discretionary, and then healthcare. And the reason healthcare has done well is because you've got 10,000 baby boomers retiring each day. The reason consumer discretionary has done well is because people are richer than they've ever been. They're more wealthy than ever before. And consumer discretionary is stuff you don't have to buy. It's stuff you can buy if you have more money. And I've been surprised that Medtronic hasn't performed like the rest of healthcare. So that's where I think we were obviously early there. We didn't have a huge weight on it, 1 or 2%, but it really hasn't performed yet. I'm holding it. I still think it's going to make a comeback at some point, and I do think it will rebound. And it again, like you said, Sam, it plays an important part for people. They're in this medical space where I think they make a lot of really critical products, medical devices, things like that. And I'm holding it. I really do think, even though we were early, I think it's going to make a comeback at some point.
Okay. All right. Well, that rounds out companies for the day. Let's talk Powell and the Fed real quick. You still want to do that?
Yeah, we can make a comment. I just pulled up the most recent comments here. He's literally talking while we're talking, so we haven't had a chance to listen to him specifically. Yeah. So this is just going off of the
I pulled the Wall Street Journal article basically and just kind of looked through it there. And share your thoughts here. Remember, July CPI was down to 3.2%. He explicitly rejected any idea that they were going to change their 2% target inflation. I know there were talks about people saying, maybe they will up it to 3%. Talk about disastrous, if you ask me. Explicitly rejected that idea. But he did say they want to be careful on proceeding with further hikes. We're sitting at 5.25 to 5.5 now. We thought there's potential for them to hike one more time, 25 basis points to 5.5 to 5.75. That would be at the next meeting in September in a few weeks here. So we'll have to wait and see. But they're really just trying to thread that needle, right? And slowing hiring and investments without necessarily creating this massive slowdown in the economy.
Yeah. Okay. So let me make one comment. I'm actually going to talk about some of his comments. I just read through the initial stuff that he said. I was watching CNBC this morning. They had a countdown clock on TV of how many hours until he spoke. It was like 2 hours, 20 minutes, 35 seconds. And the hosts were joking. They're like, this is literally the Super Bowl. Why? Yeah. Why is every time the Fed chair talks so important? Why is it such a big deal? And people are, this has never been the case. If you remember back to the Volcker years, the 80s, they would literally almost protect him like he was supposed to be hidden from public. It wasn't this big deal. He would move into meetings, move out of them quietly, and then the rate cut or the rate hike would come out later. It wasn't the spectacle that it is today. And you ask the question, why is it a spectacle? It's because the Fed is so powerful over our lives. The Fed is so ridiculously powerful. And my opinion is that the most powerful man in the world today is not Joe Biden. It's not. You have to be so careful about this. It's not the President of the United States. It's Jerome Powell. And that's a really bad thing. It's terrible for our economy because it's like the Rothschild banking dynasty said in the 1800s, I care not who makes a country's laws. If you give me control of their money supply, that is the risk to all of us as investors. It's not the fact that we could have the best tax policy. We could have the best regulation policy. We could have the rule of law and personal property rights. We could have a wonderful environment of innovation and entrepreneurship. All it takes is for the Fed, like they did the past 3 years, to print 40% more dollars in the economy. And I would call them not the primary problem here, the politicians are the problem because they're the ones who spent the money that we didn't have. But they were complacent. They allowed this to happen. They let the inflation run up for way too long, and it was politically motivated. The Fed is not supposed to be political. They're supposed to be independent of politicians, and they weren't independent under Trump. They're not independent under Biden. Janet Yellen was she was the Fed chair, and now she's the Treasury Secretary. How is that possible? How is that not a massive conflict of interest? And thanks to her, and I blame her directly, I blame Palo directly, thanks to both of them calling inflation transitory in 2020, we ended up in this mess we are in today. And they could have slowed it down. All they had to do was a couple hikes. They could have gone up a quarter point, a half point, 75 bips, 1%, something, anything other than zero. And we would have slowed down the housing market just a little bit. We would have slowed down car market a little bit. But today they're playing catch up. And I believe now, just like they were wrong on the front end, they're going to be wrong in the back end. And they're going to cause more problems for the market than people realize. And I talked about this on my show, how CPI is only calculating 32% is the weight towards housing. It really should be 52%, because not only have housing prices inflated because of the rising money supply and our dollar getting deflated, but at the same time, we have tight supply, we have no inventory, we have rising interest rates, and I believe housing now, if you do the math, is more like a 52% weight on CPI. And so the Fed knows this. They're smart people to a degree. They know what's coming. And so I think he has to hedge himself. He doesn't really know what to do, because if he comes out and he says that inflation's over and we're going to make our new inflation target 3%, that was the big debate, which was a bad debate. I don't know why people thought that would be possible. That was just wishful thinking. Then he would have even more of a problem. But if he comes out and he says we're going to raise and we're going to keep going, he's too hawkish, then he risks political problems on the other side. So I don't think we're getting good information. You have to do the data and the research yourself, and you can't trust just what they're telling you, because I do not think they're telling you the truth. I do not think the Fed is independent like they're supposed to be, and a lot of this is politically motivated. A lot of it's politically driven. I'll give a shout out to Brian Westbury at First Trust Portfolios in Wheaton down the road from us. He was one of the only people calling this out in 2020 and 2021, saying that inflation would not be transitory. He was one of the few people that helped us with our rebalance with the bond market to get very short term. And we've talked about this, Sam, on the show before, that in those portfolio management meetings where the top and the brightest minds at all these asset managers, JP Morgan and State Street and all these top companies, their top estimate for the federal funds rate was 4.5% in January of this year. He was the one lone voice in the wilderness saying that's not going to be the case. It's going to be much higher. So thank goodness for a lot of their research. Thank goodness for a lot of the people that called our attention to money supply and that not making inflation transitory. So how is it possible that our group, the Stenger group here in Naperville, Illinois, could figure this out and the Fed can't? The only reason I can is you could either chalk it up to complete incompetence, which I guess you could make a case for that, or you can say it's more nefarious, and I tend to think it is more nefarious. I think they've become politically motivated. I think they're making a lot of mistakes, and they know they are, but they're stuck. Their hands are tied, and so this is a tough environment. So stay in your equities. That's my advice. Don't let any of this make you panic, but just be prepared mentally for the fact that I think you still could see some volatility coming. The Fed's comments today show you, in my opinion, I could be totally wrong about this, that there's not going to be cuts next year. And that's what the market is pricing in today. The market is pricing in rate cuts by this time next year. I just don't think that's going to be possible.
Yeah, and short term, you may end up giving a little bit back. I know, to bring up the compound guys again here, they had Jeremy Schwartz from Wisdom Tree over there saying something similar. You just have to be careful adding duration right now. There's still a lot of risk there, and let's wait and see what's going to happen. Cuts may not be coming like people initially thought at the beginning of the year here. They may need to hold rates higher for longer. So we'll wait and see what happens. Any additional comments there? Or let's wait and see what happens. I know you'll probably go in depth on your show next week.
I mean, the only thing I'll say, Sam, is you're exactly right on bonds. You cannot add duration too soon, It's far better to add it after the fact and miss a couple of the percentage points on the upside than rather to miss it on the downside and be totally wrong. And where a lot of investors have gone astray the past couple years, in my opinion, is they have mixed up their portfolio asset allocation, and they haven't done a good job of understanding the math behind the portfolio. If you're in a 60-40 portfolio or a 70-30 or 80-20, meaning 60% stock or 70% stock or 80% stock, 40% bonds, 50, 60, 70, 80% bonds, whatever your mix is, if you get that balance goofed up, if you mix those two things up and forget what the purpose of those holdings are, you're going to end up into trouble, because what you'll do is you'll take the stocks, the equity side of your portfolio, which is supposed to be the growth engine. It's supposed to beat inflation. It's supposed to be volatile. It's supposed to go up over time, double digits. And that doesn't always happen, but that's the goal. And you go too conservative with your stocks, and you go out and you put all your money into value stocks or dividend or whatever. Now what you've done is you've permanently hampered your ability to make big returns during good markets, and then during the bad markets, you're still going to go down because stocks are so heavily correlated. You're still going to go down, maybe not quite as much as a growth company, but you're still going to go down. But then on the upside, you're not going to make enough to make it up. And then on the bond side, what they're doing, which is, remember, bonds are supposed to be safe. That's supposed to be the secure part of your portfolio to protect.
Mention, too, what you're clipping on short-term treasuries right now.
5.5.
Yeah.
Yeah. So then your bond side of the portfolio, where you're supposed to be safe and it's supposed to get you through a choppy time, people are reaching for yield. I just can't believe that. I can't understand that. Why would you take 30 to 40% of your money that's supposed to be safe and secure during a down time and then go out and buy a 10-year treasury right now? It's nuts. It's completely nuts. And so that's where you have to be so careful. Define equities as the growth part of your portfolio. Define fixed income as the secure part of your portfolio. Don't get those two things mixed up. So your fixed income's there for you when you go through a decline. The equities are growing over the long run. Yes, much more volatile, but growing over time. Get that right, and you'll have I think you'll have a wonderful experience. It's not going to be perfect. It's not going to be a straight line up, but it is going to give you consistent math-driven returns rather than basing everything off of emotion like some people have done.
Yeah, absolutely. Well, okay. Thank you for that, Nick. Let's call it there. Next week, we're going to be covering Dick's Sporting Goods, NVIDIA, Advanced Auto Parts, Abercrombie & Fitch, Bath & Body Works, Peloton, Kohl's, Lazy Boy, Foot Locker, Williams-Sonoma, Dollar Tree, Affirm, Workday, Alta, Intuit, and Nordstrom. If you like what you're hearing here, remember, make sure you subscribe, share with others. You know, if you want more of an overall update and you haven't yet, check out Nick's show. It's called The Nick Stenger Show. It's on YouTube, Spotify, Apple. Another great one to listen to if you haven't listened to that yet. If you'd like to learn more about Stenger Family Office, visit the website. Give us a call at 630-912-8431. Request a complimentary starter kit. You can start a relationship with us at just $1,000. 3 events. September 7th at Gibson's in Oak Brook, we're going to have the legendary Dr. Jeremy Siegel, also from Wisdom Tree. September 20th, hosting a happy hour in Spring, Texas. Would love to see our Houston folks there. Going to be celebrating our new office. And then finally, November 14th and 15th, our annual Investor Day at Hotel Indigo in Naperville. Thank you for listening. It's Friday, so we hope you have a wonderful weekend.